Good morning. I'm Kim McGrew with Kauffman FastTrac. Welcome to FastTrac's September author series. I'm pleased to introduce our author today. Dawn Fotopulos is presenting her book, Accounting for the Numberphobic, a survival guide for small business owners. Professor Fotopulos has addressed thousands of entrepreneurs to standing room only audiences as a panel moderator for the New York Times, Amex Small Business Summit conferences, expert guests on MSNBC, and accounting for the Numberphobic seminars. Over her 20-year career, she has been a successful banker, real estate investor, and serial entrepreneur. Her passion is to encourage profitable business formation in the U.S. She received her bachelor's degree, Dean's List, from Cornell University, and her master's in management with distinction from the Stern School at New York University. Dawn Fotopulos is also Associate Professor of Business at the King's College in New York City. Her courses include Business Strategy and Principles of Management at the college, and also the Levin Institute for Entrepreneurship. She is also founder of BestSmallBizHelp.com, recently named one of the top 10 small business websites online. Its mission is to equip small business owners to interpret their financial statements so they can thrive in any economy. The panic button on the site is the only live help desk for small businesses online. Professor Fotopulos is on a mission with her book. As a certified Kauffman FastTrac Facilitator, yay, she has prevented hundreds of small business failures with the content in this book. Now the goal is to reach millions before they close their doors. So I'm very, very happy to hand this over to Dawn.
Kim, good morning, and thank you for that marvelous introduction. Everybody who's on the call, thank you so much for taking time out of your busy lives to be with us. I'm excited to have you here. I hear that many of you do have your own businesses, or you're thinking about starting your own businesses. And here's the deal. You'd never play a game without learning how to keep score, and we're going to help you do that. And we actually have a sense of humor in the process. So how can we take this dry, awful topic and make it really relevant for you? That's the purpose of today. So accounting for the Numberphobic actually started about 7 years ago when I went to the National Association of Women Business Owners and I said, I want to talk to your people about this topic. And it was 7:30 in the morning, and we figured 2 people would show up, and we actually hit fire code restrictions. And it was after it was over, there were probably 50 people waiting in line like the receiving line at a wedding, and half of them had tears in their eyes saying, I didn't know I was going bankrupt till I came here. Those were a number of comments. Other comments were, for the first time in my life, I finally understood this stuff, and it will change my future. So we're going to take the first step, hopefully, to changing the future of all the people that are on the call. So thank you again for joining us. So the Accounting for the Numberphobic is really a survival guide for small business owners, and it's really about business strategy and making good decisions. But the question, of course, starts with, well, what the heck is a numberphobe? A numberphobe is somebody who is not just intimidated by the numbers, but is utterly terrified by them. And I have found people in the creative disciplines, fashion designers and interior designers, particularly are numberphobic. And here's the good news. We read numbers every single day. The numbers are indicators. The numbers give us feedback and tell us about our environment and what's going on. So, you know, we read our numbers when we weigh ourselves, or when we look at a thermometer and see what the temperature is outside, or we look at our bank account balances, for better or worse. But we read numbers every day, and they're intuitive for us because we've been doing it for so long. So you know how to do this instinctively, and I want to encourage you to tell you that you do. But the problem is that most small business owners never, ever look at their numbers because they think their accountants are going to do it for them, and your accountant is not going to run your business any more than your mechanic is going to drive your car. So let's just remember something about a thermometer. Let's just use that as an example. A thermometer does not tell you how to dress in the morning. Think about that. All it does is it measures the amount of heat or lack thereof in the environment. It is up to you to figure out that if it's 90 degrees Fahrenheit outside, probably not a good idea to wear, your down coat. Somebody in your life had to tell you if the thermometer reads a certain level, that therefore you can make some assumptions about your environment. And when we talk about your small business dashboard, your financial dashboard, that's all that is. It's an indicator that's going to give you some feedback as to what's really going on with your business. So would you drive your car with your eyes closed? Of course not. Then why do you run your small business without knowing how to read your financial dashboard, which is nothing more than your income statement, cash flow statement, and your balance sheet? We'll get into that in a second. But basically, those three statements together give you a 360-degree view of your business, and they are your global positioning satellite for running your company. So what if it was possible to work half as hard and make twice the money? What if that were possible? What if you could run your small business free of debt or outside investors, which means that you have a lot less stress in your life, and you don't have investors meddling in your life telling you what to do. You actually do have the freedom to make your own decisions. And what if you could finally get a return for all your sacrifices and sleepless nights? There is not one single small business owner I have ever met, and I have met thousands of them, that gets more than probably 6 hours of sleep a night, and that works less than 6 days a week. That not a single one, but I believe that you can, and I have proven it in the real world. And this book really is nothing more than the culmination of 15 years worth of work. And so we finally have codified it. So the question is, is it real? Is this really possible? And the answer is yes, because we've already had small business owners benefiting from the ideas in this book. So there was a jewelry designer who had been in business 9 years, did about $750,000 a year in business. He was very successful, a very good jewelry designer, had 300 clients, but he was really close to bankruptcy. And what we did was we taught him how to reduce expenses, how to cut his product line, because more products doesn't necessarily mean more profits. And we taught him how to increase his gross profit and his gross margin. And if you don't know what any of those terms mean, don't worry, because the book covers you. We assume that you are wonderful at what you do, but that you don't know any of this stuff, so we take you through it step by step. We had a photographer, very talented lady. My goodness, her stuff should be in the Metropolitan Museum. It's so beautiful. And she actually took my profile picture on the back of the book, and I went to her. Her name is Denise Sitzman, and I said, Dee, you got to make me look like Diane Sawyer, and she mercifully complied. And after we were chatting, after the shoot was over, I asked her how the business was going, and she burst out crying, and I said, that's a bad answer. And here's this woman who's so gifted. She's got a really great client base, but she wasn't making a whole lot of money. So we changed her target audience, and the book goes through all of this. We changed her pricing structure that more accurately reflected what made her special and different in her marketplace. And we made some minor course adjustments in her marketing strategy, and within 6 months, she was making more money than she had made in the previous 5 years. So an interior designer, okay, same drumbeat, right? Somebody who's very talented, doing a great job. Her clients loved her, and she was killing herself and not making any money. And so we looked at her business model. We went through her profit and loss statement, figured out that her pricing structure needed to change. She needed to focus on certain services that were profitable and let go of others that were not. And she needed to improve her collections process, because there were a ton of people that owed her money. She had done the job, and she hadn't collected that cash, which she really needed to run the business. So for the dreamers who want to launch small businesses, this is for you. So here are a couple of statistics. Did you know that less than 2% know that a net income statement and a profit and loss statement, or a P&L, are exactly the same thing? Do you know that less than 1% of the people that I polled, and I polled 5,000 of them, all small business owners, less than 1% know that they run their business on gross margin, not on revenues. And this is not a problem, it's an epidemic. And if you want to know the difference between net revenues and net income, all you have to do is look at those little piles of money on the side. And that illustration, by the way, was done by Ron Bucalo, who was my illustrator for the book, and he worked for Disney for 20 years, and he's got a fabulous sense of humor. And I said, how do we illustrate this idea that net income is not the same thing as net revenues? And net revenues are basically your sales, that big pile of money on the far left. And then you got to pay all these people in the meanwhile, right? You got to pay your taxes, and you got to pay cost of goods, and you got to pay insurances and all of that. And after you're finished paying all those expenses, you're left with net income. And people need to understand not just how to manage sales, which is net revenue, but you need to manage all the expense categories in between in order for you to maximize your net income, because here's the big head fake. You are in business for net income. That's what you get to keep. And the bigger that little pile of money is, the more it's worth your time to run a small business. So here are the three big questions. And every small business owner, by the way, has to answer these three questions. Are you making a profit? Is there enough cash to run the business? In other words, to pay your bills? And is the business building wealth, or is it destroying it? And your financial dashboard is going to answer these questions. So this is your financial dashboard in sum, right? Your net income statement, your cash flow statement, and your balance sheet. And we use that as a metaphor because most people drive, and most people understand what a dashboard is. And we use the net income statement as sort of your speedometer. You know, are you generating profits, and how fast are you generating profits? The cash flow statement is a lot like your gas tank. You know, if the needle's on empty, the gas tank doesn't tell you to go buy gas, but you and I know by now that if we don't buy gas, we're going to have to suffer the consequences. And cash is to your business as blood is to your body, as gasoline is to your car. If you don't have enough of it, it's going to be it's going to put you in a crisis. So we want to make sure that we measure how much cash we have so that we can manage it to be able to run the business without the crises occurring. And your balance sheet is a lot like your oil pressure gauge. You know, you want enough pressure in the system so that the engine will run, but not so much that you blow a gasket. So your three gauges, in short, are your net income statement, your cash flow statement, and your balance sheet. And it really doesn't get a whole lot more complicated than that. And chapter 1 and 2 and 3 of the book pretty much take you through it. Chapter 1 introduces the net income statement, and chapters 2 and 3 will take you through how it works, right? Are you making a profit or showing a loss? And it's basically money in and money out. Money in from sales, money out from expenses. So money out are all the expenses to run the business. Some of them are direct, some of them are indirect. You've got all these various expense categories. And don't let it be more complicated than it is. You've got money in coming from sales, essentially, and then you've got to pay your bills, and what's left over is your net income. And the ratios, in other words, how much net income do you generate as opposed to revenues, will help you kind of keep your decision-making in balance. So what that really means is, for example, if you're running a grocery store, of every dollar that you bring in revenues, how much of that is actual net income? In other words, is net profit. If you're running a grocery store, I know this is going to be a really shocking statistic, but for every dollar you bring in, the average grocery store in most places in this country only gets to keep 1.5 cents of that dollar as net income. Remember those big piles of cash we showed you? If net revenues are $1, net income for a grocery store is $0.015. That means that it's really important that you measure and you manage all of the expenses in between. So if you're in an industry, there's a norm for your industry. In grocery stores, it's anywhere from $0.015 to 2.5 pennies. In your industry, it may be something quite different, but you should know what that is. And if you're part of an industry trade association, they would have those numbers. So that net income ratio is nothing more than just your net income divided by your revenues. Okay, gross margin. Nobody knows what this is. Gross margin is the same thing as gross profit. And whenever you see gross in front of a term, it just basically means before expenses. So again, if we go back to our piles of money and we start with our net revenues, which are our sales, and if we're selling, for example, at a grocery store, we have to buy all of those raw goods, right, canned goods or fresh goods, whatever, and those are our cost of goods that we're going to be selling to the public. And after we pay for all of that stuff, we have a markup because, after all, we're providing some efficiencies to our customers. We make it easy for them to come in and do their weekly shopping in 20 minutes and so on. That's our gross profit. So if something cost us 50 cents and we sell it for $1, our gross margin in that case is 50 cents. That's pretty simple. If something costs us 30 cents and we sell it for 50 cents, then our gross margin would be 20 cents. What we are arguing for, and what the book takes you through, again, step by step, is that your gross margin needs to be at least 30% of your revenues in order for you to stay in business. Said another way, if your gross profit is not at least 30 cents on every dollar you take in, you can't afford to pay your bills. And you won't hear that anywhere else but here. And it's interesting because I've spoken to other people, and recently they've been saying that number should be about 35 cents of every sales dollar should be gross profit. But what that's saying is, if you're running a business and you're having trouble paying the bills, there's a very high likelihood it's because your gross margin isn't high enough, and there may be a number of reasons why it isn't. It may be that you're servicing unprofitable customers. It may be that you're selling unprofitable products and you don't even know it. And you don't know it because you can't read your net income statement. But in the book, we take you through sort of that simple diagnostic, and we have some key takeaways at the end of every chapter that will help you do the diagnostics on your business and say, hey, just like going to the doctor, right, checking all your vital signs, how is this going? How is your product line? How are your customers? Are you earning money here? Are you earning adequate profit there? And if you're not, here are the 3 things you might consider doing in order to fix that. So we don't just ask you to go through the diagnostics and leave you hanging. We actually do give you some suggestions as to how to fix it. So how many people on this call know that your business could be showing a profit and still be going bankrupt? This is a true statement, by the way. So it's entirely possible that you're reading your net income statement and you're looking at your bottom line, and your bottom line is profitable and it looks like everything is fine, but your cash is not adequate. And the definition of bankruptcy, by the way, is running out of cash. That's what happened to Bear Stearns. So it can happen to the biggest or the smallest businesses. So it's not enough to measure whether or not you're earning net income. So it's not enough to look at your net income statement. You also have to look at your cash flow statement, which is why it's on your financial dashboard. So Chapter 5 takes you through the cash flow statement. And it's like the checkbook for your business. That's really what it is. And it's not a whole lot more complicated than that. So you've got your starting cash, again, just like your checkbook, right? Cash comes in, one can only hope, because people pay you. Cash goes out because you got to spend money for your expenses, keep the business going. Either you have to buy more product, or you got to pay your web designers, or your insurance, or your accountant, or whatever. So you got expenses, and then you end up with what's left over, which is your ending cash. And it is like the gas tank in your car. It's like the gas in your tank, and basically what it does is it helps you predict how far you can travel with the amount of cash that you have, or the equivalent in running a business is how long you can run the business without needing more infusion of cash or needing more cash. And what does that mean? It means that you can actually do a projection. Most of us pretty much have a good idea of what our expenses are. I mean, we do. The harder thing to predict is what your revenue is going to be, because sales can be kind of variable. But expenses are pretty predictable. And so it's really helpful to look forward, not just for next month, but to look 3 months out, and the book helps you do this, and to do some cash flow projections. Because the one thing that we talk about in the book in Chapter 9 is how to deal with your bank. So, for example, you don't ask for a credit line when you're in a cash crunch. You ask for a credit line when you have cash in the bank and you look like a great credit risk. So the credit line, for example, would be very useful If you're in a slow period in the year, you've got a lot of expenses. Let's use that photography business, for example. Slow period is January, February, March. Nobody's taking pictures in those months, but this person still has to pay insurance and still has to pay the web designers and so on. A good time to use some of that cash, the cash line, to bridge her for the second quarter when she starts taking photographs again for weddings and graduations and so on, and revenues start to pick up. So your gas gauge doesn't tell you to buy gas any more than the cash flow statement tells you, gee, you should really take down some money on your credit line, but it's really up to you to interpret where the cash position is on the business and how much you're going to need at least for 90 days. And again, the book takes you through this, so don't be intimidated if what I'm saying doesn't really land well. We make it super easy, and like I said, we have a really good sense of humor about it. So, okay. One of the great questions that was asked in one of my seminars is, well, why do I need to manage cash if I already can tell what my revenues are on my net income statement? And if you can remember, revenues are the very first line on your net income statement. And the truth is they're not the same. And they're not the same for a variety of reasons, which is why we have to track both revenues and cash. So why aren't they the same? Well, you might get delays in payments. You might do a job for a client, or you might sell something to a customer. You book the revenues when you do that, but the customer may not pay you right away. If you're an interior designer or a contractor or a photographer, you may take the pictures today, you invoice the client, and maybe the client doesn't pay you for 30 or 60 days, and that time lag becomes very important, and you've got to manage that. And your cash flow statement will help you do that. Sometimes clients will take discounts to payment. If they pay you within 15 days, they don't pay you 100% of the invoice, but they pay you 95% of the invoice. That's very common in retailing. If you are a clothing designer, when I had Bedazzled Incorporated, for example, we sold screen-printed T-shirts, and it was very common that when we sold to very large retailers that they would take a discount. There are times where, you know what, clients go bankrupt, and it's not a happy situation, but as much as they wanted to pay you, they just simply can't because they ran out of cash. So we book our net revenues when they happen, and that's important to capture an accurate sales cycle reporting, right? So we know when the sale happened, but it's really important to book the cash when it actually arrives, when it actually is received by the business, so that you can have an accurate cash cycle, cash reporting cycle. And that's important because then you have a really good idea of when you can pay bills. So, you know, it is very possible to improve cash flow, and there has never been a single small business owner I have ever worked with that has not been able to improve their cash flow just with simple changes in how they manage. They don't need outside cash. They got to make sure their invoicing policies, for example, are done professionally. So here's here's a statistic. 50% of service providers do not invoice their clients on a timely basis. I cannot tell you how many service providers, and it doesn't matter what they do. Contractors are terrible at this. You know, fashion designers are terrible at this. IT consultants, I could go on and on. They do the work, they do fabulous work, and then they don't invoice the client for 60 days. Well, if you don't take getting paid seriously by waiting 60 days to invoice the client, and that's when the clock starts ticking, by the way, then why on earth should your client take you seriously? So invoicing policies are absolutely mission critical to making sure you get paid. Collections policies, don't wait until the invoice is 60, 90 days old. Call up the client and have a happy dialogue with the client. And one of the things we do in the book is we tell you exactly how to do that. I know it sounds like you're begging. You're not begging. You did the job. You did a wonderful job. You deserve to get paid for it. But there's a way to reach the client, reach out to the client, and get paid sooner than most of your competitors with simple collections policies, again, that we take you through step by step. And it can be a relationship builder with the clients. It does not have to put a wedge between your client relationships. And again, we show you how to strengthen those relationships. And all of this affects your cash flow. And you need to keep that cash flow healthy. I've had a lot of people come to me to say, I want outside investors, when they don't need outside investors. What they really need to do is manage their invoicing and collections policies, and they'll be fine. So the third question is, what's the value of a business? Are we building wealth, or are we destroying wealth? And the question that we ask is, if you're at this business for 10 years or 15 years, and you're getting tired, and you decide, well, what's the end game for this? Is it just the salvage value of the desks and the computers? I mean, is that it? Or does the business have some value where the business itself can be sold, where the business becomes an asset in and of itself? And if you take a look at the, the big high-profile sales like Instagram for $1 billion, you say, well, yeah, a business can absolutely have terminal value. And in fact, everybody on this call and everybody that reads this book should be thinking about building a business that they can sell. And they need to be able to sell that business for more than their annual revenues. And the way you're going to do that is to strengthen your balance sheet so that somebody can come alongside you 10, 15 years from now and pay you a big wad of cash for all your time and energy and investment to build this wonderful business that very few people have the courage to do. So the answer is yes. You can sell a business, and it can be worth more than simply net revenues. So, okay, Chapter 8 is a really important chapter because it teaches you the language of not just bankers but investors. And if you're going to be running a business, you got to be savvy about this stuff. And I was a banker. Kim gave that wonderful introduction earlier, but I ran a $130 million business for one of the large global banks. I was a vice president for this bank. I was a line manager. I did a number of turnarounds. I wrote business plans for a lot of these small business owners that were my clients. And I can tell you that if you understand your balance sheet, which is the net worth statement of your business, it will go so far in making the bank your collaborator and not your adversary. It is, the same way you have personal net worth, right? You have it in the business as well. And it's the relationship, basically the balance sheet measures the relationship between what you own and what you owe. And the difference between that is your net worth. In other words, your assets are what you own. Your liabilities are the things that you owe to others, namely credit lines or mortgages that you have to pay back. And if you take the difference between those two, what you have ownership of and what you owe to others, that balance, that remainder, hopefully it's positive, is your net worth. And your balance sheet will help you do that. And every business in the world, no matter how small or how large, has those three key areas: your assets, your liabilities, and the third part is your owner's equity. So that's essentially what this slide reveals to you. And this is how it's shown on a balance sheet. Positive net worth, or net worth that increases over time, positive owner's equity is what you're really shooting for. And negative net worth is when your liabilities are growing faster than your assets, and that's a problem. And you got to do something about that before you end up bankrupt. And it's interesting because in my interview with Brodsky, which is Chapter 10, he's a very, very successful entrepreneur. And he's lived on both sides of the desk. He's gone bankrupt twice, and he's also been wildly successful. He sold his businesses for hundreds of millions of dollars. And I love him because he's so reality-based, and he understands the importance of understanding your financial dashboard. And he said something to me that really opened my eyes. He said, if your current liabilities are greater than your current assets, you will go bankrupt. It's just a matter of time. And I said, Norm, nobody thinks like that. He said, but you got to measure it first to really understand where you are and to understand if, in fact, you're on the right path or if you're going down the road, the road to bankruptcy. And you don't know that unless you can measure it, and that's what the balance sheet helps you do. And these three categories, assets, liabilities, owner's equity, are the only major categories on every balance sheet. That's how complicated it gets. So, okay, what's our mission here at Best. Small. Biz. Help, and what's the mission of the book, Accounting for the Numberphobic? I can't stand on the sidelines anymore and watch these wonderful, creative, fantastic people go bankrupt simply because they're not making good decisions. When I spoke to Norm, he said something that broke my heart. He said, you know, half of the businesses that are going bankrupt don't have to go bankrupt if they just knew these basics. And it broke my heart. And I said to him, you know, I don't accept a 50% failure rate as inevitable. I just refuse to accept that. We can change those odds. So if you are a struggling small business, or if you know somebody who is struggling, we can teach them how to make their course corrections, but not just reading their financial statements, but interpreting them. And by the way, the book does not argue for you to become an accountant or a bookkeeper. You have those people in your life to do your taxes, to capture all of the transactions that are going on in your business. What we're really arguing for is to be able to interpret these three key statements that your accountant or your bookkeeper will pull for you at the end of every month. Just look at it. Just like taking pulse checks with your health, you've got to take pulse checks in your business. So if you can do this, you can begin to anticipate what will happen in the business. So you're running the business isn't running you. And what's the point? The point is, if we can understand a decision today and what the implication is going to be for that decision a month from now or 6 months from now, that's the Holy Grail. And I can tell you, I believe that together we can reduce the failure rate of small business by half in this country. I really, truly believe that. And Chapter 10 is this marvelous gentleman that you see here. It's on the Brooklyn waterfront. This is Williamsburg, Brooklyn. It's got the best view of Manhattan. When Norm started his city storage business there 30 years ago, he homesteaded and built his huge storage facilities when nobody wanted to live in Williamsburg, Brooklyn. And he just sold that business for $100 million about 2 years ago. And he says the following, you know, business is all about the numbers. And he said most businesses could make it if they knew even the very basics of what you and I just talked about. So some of the comments of the people who have read Numberphobic, the book has been out for about a month, and you can buy it, of course, at Barnes & Noble, Amazon, and Indie Books. But they'll say things like, it's so much fun to read because we actually do have a sense of humor. And it's interesting because there are a lot of stories of people just like you who are running service businesses or who are selling products, and they're marvelous. They are the engine of the U.S. economy. They are the engine of innovation. They are the engine of new business formation and new job creation, and I love them. And a couple of them have said to me, I'm sick of being a starving artist. You know, I want to offer my gift to the world, but I also want to support my household. And you can do that with what you learn from the book. Someone said it should be required reading before anybody goes into business. It's so empowering. That actually was the gentleman who's head of the Finance and Economics Department at Utah State University, and his name is Chris Fossen, Dr. Chris Fossen. And they have an incubator out there, and he is going to be using this book as a text in the Arts and Science School as well as in the business school, so I'm very excited about that. Someone else who runs a women's nonprofit said women entrepreneurs especially need to read the book. They're afraid of debt, but if they knew how to manage it, their businesses would be more successful, and I believe that's true. And an interesting statistic about women business owners, they are starting businesses at 3 times the rate of men, and yet their revenues are anywhere from 50 to 75% lower than their male counterparts. So they are a very important driver in the U.S. economy, and we need to make sure that they're successful because they're taking all that startup risk, and we need to help them get to cruising altitude as quickly as possible. So just a few takeaways. Your financial dashboard is your global positioning satellite. It helps you figure out where you are. It helps you identify some concrete goals of where you want to get to, and it helps you measure along the way. Your net income statement, your cash flow statement, and your net worth statement, which is your balance sheet, are the 3 things that every small business owner needs to understand. Your net income statement shows you if you're showing a profit, if you're breaking even, which is 0 profit, or if you're showing a loss, which is negative profit. And believe it or not, you can still keep a business viable if you're showing a loss. You can't do that forever, of course. But if your cash flow statement is adequate, if your cash flow rather is adequate, you can continue to run the business as long as your invoicing and your collections policies are sound. And those are really simple fixes you can do today that will have a major positive effect on your business going forward. And your net worth statement or your balance sheet will show you whether or not you're building or destroying wealth, and that matters because that's the long-term game. You want to make sure that you're building something that you can eventually sell so that you can have something in your retirement. So if you understand your dashboard, you are reducing risk by definition, but more importantly, you're also identifying opportunities. So, Accounting for the Numberphobic, a survival guide for small business owners, is the only book on the in the marketplace that will teach you these things. And it's available at Amazon, Barnes & Noble, Indie Books. It's also available in a Kindle version. It's also available as an audiobook. And please follow me on Twitter, and you can do that one of two ways. I'm at Fotopulos or at BestBizHelp. And Best Small Biz Help is my blog, and I know we're going to take questions in a minute, and Kim is going to help triage that. But if for some reason we don't get to all your questions, please send them to Kim. She's going to send them to me, and I'm going to answer them. I will publish them, the answers to your questions on Best Small Biz Help, and I will promote it on Twitter so you know that your question is up and ready to go. So make sure you follow me on Twitter. Not only that, but on Twitter, I'm going to start promoting a number of things. This conversation is just the beginning of the Know Your Numbers campaign, and that's going to be a year-long campaign to not just promote the book, but to promote financial literacy for small business owners, because the idea is we got to get them before they close their doors. So you're going to see that hashtag on Twitter. On October the 7th at the King's College in New York City, we're going to have a book event. It's going to be a book rally, and it's live streamed, and that's the live stream URL. And I hope you book that on your calendar, because we'd love for you to join us virtually for that. And you also have the opportunity to test your own knowledge. We have a free survey on Best Small Biz Help called Know Your Numbers, and it's a very simple 10-question true-false. And if you get 100%, woohoo for you. We'd love for you to be part of our team. And if you don't despair, because we can help you learn what you need to learn to be successful. So if you want to work half as hard and make twice the money, if you really care about building a business for the long haul, if you know somebody that you really care about who's struggling to run a small business, we can help them do that. So let everybody you know about the live stream. Follow me on Twitter. Follow the hashtag Know Your Numbers. And I look forward to your questions, and I thank you so much for your time. It's just a blast being with you. Kim, thank you so much for Kauffman's gracious invitation for being here. And I'll take any questions you have.
Thanks, Dawn. It's a pleasure to have you join us as well. We do have some questions, and we have a few, so any of you that are participating here, if you have questions, please feel free to type those in under the questions bar. But Dawn, going back to talking about the gross profit margin, we have a participant here that is talking about, people really don't know how to calculate GPM in their experience. And then also wanting to talk about how to calculate, should it be 30 cents per dollar, 40 cents per dollar, but in your book you mentioned too that every product or service must have a gross margin of at least 30%
yes.
of net revenue, or 45% above the cost of goods sold.
Yes. Okay, so let's talk first about a product business, and then we'll talk a service business, because it has slightly different dynamics. I'll use Bedazzled Incorporated as an example, and that's that we were t-shirt manufacturers. So we had to buy fabric, and we had to screen print it, and then we had to sew them up and tag them and all of that. Those direct expenses, direct labor and direct material expenses, were our cost of creating a final product. And cost of goods basically has two components, cost of materials, and direct labor. In other words, if we didn't invest the money in those key things, those direct materials, direct labor, we wouldn't have a final product to sell. That's what cost of goods is for a product business. Now, sometimes you can buy that product as a wholesaler, fully made, ready to go, and you just simply distribute it. A lot of people do that on Etsy. A lot of people will do that through the Amazon store. But the point is, we know pretty much what our cost of goods are if we're running a product business. We know what it is. So let's assume it's 10 bucks. If it is, and we have to mark that up in order for us to make a gross profit, we have to make a gross profit. And we should make a gross profit because we're offering value to our constituencies. The book says you've got to mark that up, at least I believe it's at 45%. Is that right?
Correct.
Okay, 45%, which means you're working off a smaller base. Cost of goods is working off a smaller base, so you have to mark it up 45%, or 30% of net revenues. To keep the equation really simple, let's just say that whatever you charge for that T-shirt, what it cost you should be no more than 70%. So if you charge $10 for the T-shirt, you can't afford to distribute or sell that T-shirt for less than $10 because it cost you, let's say, no more than $7 to make. If the T-shirt costs you $8 or $9 to make and you're still selling it for 10 bucks, the point here is you're not going to have enough gross margin in order to pay the rest of your bills for the business. So there are two challenges with this. If your cost of goods are rising, and a lot of people's are because there's real inflation in the system, you have to ask two questions. Can I raise my prices and will people pay it? Because you got to protect your gross margin, right? If you can raise your prices, then great, but in a recession that's hard to do. So you may decide to change the componentry of the item to reduce costs. You don't have to cheapen the item, but maybe just change it. So for example, when we had Bedazzled, our first year we screen printed on both sides of the T-shirt, which was expensive for us to do, but that raised our cost of goods. So in the second year, when we wanted broader distribution, we wanted to bring our prices down, but we had to bring our cost of goods down at the same time. You can't just lower prices without lowering your expenses, otherwise you kill your profit. Does that make sense? So what we did was we said, okay, we're just going to screen print then on the front of the T-shirt, same wonderful fabric, but it's going to reduce our cost of goods like by $2 a shirt, which meant that we could reduce our retail price and still protect our gross margin. So that's a product business. That's the analysis you go through for a product business. For a service business, it's really important that you account for your time, because your cost of goods really in a service business is your time. And if the client says to you, oh, this particular service that you're offering, you know, and it usually takes you 2 days to do this, we want it done in 3 hours, and they want you to charge them the same amount of money, you can't do that for the same amount of money. And you're probably losing money on that client. So what we suggest in the book is if two things change, either if the deadline changes and they want you to do a crunch deadline, or if the scope of the work changes where initially they wanted you to do A, and then as you go down the yellow brick road, the client says, oh, no, we changed our mind, we want you to do A, B, and C for the same amount of money, you've got to go back to the client and you've got to say, we agreed by contract that we were going to do A as a scope. If you'd like to do B and C, we'd be happy to do that, but now that's going to change the price of the contract, because that's a fair dialogue, and we're encouraging the service providers to have that dialogue. So you give the client the choice. Either they get the A, B, and C and they pay for it, or if they don't want to pay for it, they just get the original scope and you're not out all that time. The other thing that we talk about regarding service businesses is if the client's asking you to get something done in a very short period of time, and you know that in order for you to get it done, you're going to have to work late into the night, or you're going to have to hire some subcontractors to help you get it done, you need to get paid for that. So what we suggest is if you charge, for example, on an hourly rate, if you have to work after 6 p.m. in order to meet the deadline, not because you don't have your act together, but because the client is asking for a very quick turnaround, then you've got to bake that into your contract and say, well, you know, any work that we do prior to 6 p.m. is going to be at $50 an hour, but after 6 p.m. it's going to be $120 an hour. Then you give the client the choice to give you a proper amount of time to get the job done at $50 an hour, or if they really need it quickly, to pay you that additional freight. And that protects your gross margin. The other thing that both service and product companies should think about is what value are you adding. So for example, because that determines what you can charge for what you do. If you're a commodity, you're competing on price and you're going to go bankrupt, it's just a matter of when. So as small business owners, we really need to be niche players, and we need to do something better than anybody else. So there was one service provider, she was a doctor, she still is, and she specializes in FDA regulations. And because she's done this for so many years, she can reduce the amount of time it takes for a pharmaceutical company to get approval for a drug. Now, you and I can only imagine the value of that she brings, right? If you can get approval by the FDA in a year instead of 5 years, that's worth hundreds of millions of dollars to a pharmaceutical company. And she was charging $250 an hour for her time, and which I thought, frankly, was a deal and a half. And the pharma companies were screaming, saying that was too much money. So I looked at her and I said, look, you turn around and say to them, I am not charging you for my time. I'm charging you for my years. Would you pay $10,000 or even $50,000 to make $100 million? I think that's a pretty big no-brainer. So those are some of the things that we talk about in the book. That gross margin must be at least 30%, and here's the thing, if you can't get 30%, then maybe you shouldn't be selling that product or service. Let somebody else sell it that's going to be more efficient at offering that, or that can control their costs better than you can, and find a niche where you can make a 30% gross margin.
Great, thanks, Dawn. I want everyone to know, we're getting some great questions here. If we run out of time and we don't get to your questions, I will forward these questions to Dawn, and they will either be published, the answers will be published on the website, Dawn's website, or I'm also going to provide her, I believe I can get the email addresses from the askers, so we'll work through that. But again, thank you. And so that you all know, because there's several questions on this, this webinar is being recorded. It will be available out on fasttrac.org/authors, which is our author series landing page, by the end of the week. So you'll be able to access the recorded webinar, as well as we'll have the slides available there also. So Dawn, another question here is, what is the best source to handle per diem bookkeeping, who can keep up with the record keeping so that I don't fall behind?
Oh, that's such a good question. And I have to tell you, if you have a great bookkeeper, it's like the best, it's better than Valium. You know, it really is the best sleep at night factor. Bench.co, bench.co, is a very big trusted resource for bookkeeping. And you can find them online, and I would recommend them. There are others, but I think they're probably the best known. And you send them the data, they do your monthly, there are really only 3 things. They do the monthly reconciliations on your bank accounts, and by the way, everybody who's listening, if you run a small business, you should keep your personal and your banking transactions separated. You should have a separate checking account for the business and a separate checking account for your personal personal things. There's nothing that the IRS likes better than to audit people that commingle funds. Even if you're not incorporated, even if you don't have a formal structure for your business, you should still keep them segregated. And a company like Bench.co will do the reconciliation on your bank accounts and your transactions on your credit cards. Again, separate credit card for business, separate credit card for personal. And they'll do the books, right? And QuickBooks, Intuit's QuickBooks is the industry standard software platform that most accountants just love, and they can connect to it very easily. And if you have a good bookkeeper, they won't charge you per hour what an accountant certainly would. And I frankly have a bookkeeper, and I also have an accountant, and my bookkeeper keeps me honest and, you know, pumps out my reports every month, and then I send those all of those reconciled reports to my accountant at the end of the year, and it just takes him a very short time to put my taxes together because we've basically done all of the reconciliation. But it's important to have an accountant because the accountant's going to know the changes in the tax laws, and both federal, state, and city tax laws. In New York, we have to worry about all three. And I want somebody that's got their eye on all of that because I don't frankly have the time, and I don't want to have to learn about GAAP accounting principles and all that. I mean, I have a general understanding, so when we chat, you know, I know what he's saying. But I would try Bench.co, and in fact, we've written a number of articles about different types of accounting software and bookkeeping software on Best Small Biz Help. So I can certainly put those links up and promote them on Twitter so people can read those as well. And in fact, maybe what we should do is a little bit of research too and see what else is available. The bookkeeping community is a very important part of supporting the small business ecosystem, and I have a lot of respect for the good ones that are out there.
Okay. I have a comment here from one of our participants saying that she bought the book this week, and it is helping. A question that she has is, can you talk about the dashboard in the case of a new patented product with no sales yet?
Well, thank you, first of all, very much for buying the book and taking that step of faith. Whether you have revenues or not in a startup, you still have expenses, yes? You know, and that's, there are two things that come to mind. The first is you still have to track those expenses, and you're going to track them in three ways. The first is on your net income statement. You've got all those expense lines. So even if you have zero on revenues and you have, you know, a negative bottom line, you still have to track those expenses, and you certainly have to track them on your cash flow statement. So even though you don't have cash coming in, you probably have starting cash, right? You started with a certain amount of money. Because you wouldn't be in business at all if you didn't have that. I'm sure if you have a patented product, it costs you some money to patent it. It probably costs you some money to develop it. And you need to capture that, that history, certainly. And if you took out a loan to start the business, you're going to capture that on your balance sheet. So those are three places where you're still going to see activity even though you haven't generated revenues. But for this person who's starting out, and for everybody else who's listening who started out, Chapter 4 takes you through what break-even is. And essentially the challenge for us as small business owners is we're really financing time, because it takes time to ramp up revenues. It takes time to find customers. It takes time to build relationships with those customers who want to buy from us again and again and tell the world how wonderful we are. You know, it takes time for those viral effects. But meanwhile, we still have expenses that, like a drumbeat, every month, you know, we have to pay. So the break-even point is when your revenues from sales equal all of your expenses. And that's when the business starts to, like a toddler, you know, can stand on its own 2 feet and can begin to be self-sustaining. So you've got to keep track of those expenses, whatever categories they are, because you need to know how much in sales and gross profit you need to generate to cover those expenses. So for example, if my expenses are $1,000 a month, all in, everything together, I need to generate a gross margin of $1,000 a month in order for me to pay for all of that. If I'm generating a gross margin of $1,000 a month, I need to be generating $1,450 a month, given the analysis in the book, in order for me to get to break even. And if nobody was able to follow what I just said, no worries, because we take you through it in the book. But the real challenge is to keep expenses as low as possible for this lady, as long as possible, until she can start generating revenues, because it takes time.
Okay, Dawn, I have another question here. Somebody wants to know, what is the best practice? When should you invoice?
Okay. If you're a service provider or if you are shipping product, when you ship a product out the door, like when we were shipping Bedazzled t-shirts, the day the product went off the loading dock is the day the client got invoiced. And these days you can invoice a client electronically, so they don't have to wait for snail mail to receive the invoice. And in fact, I really love invoicing electronically because you have a record of exactly the date and time stamp that they've received it. And you can also make sure that you can check to see if they've opened the email, so the old excuse, oh, I didn't get the invoice, isn't good enough. So you have to invoice the day you ship the product or the day you complete the assignment. You don't put your head down on the pillow that night until you get an invoice out to the client. So that's the very first thing. You do not wait to invoice a client. The second thing is, on that invoice, you should tell the client the value that they receive. Now, I'm a consultant, and I charge out at $500 an hour. And that's a lot of money. But I never invoice a client without putting in the body of the invoice exactly what the client got for my time. So I can do in an hour or in 2 hours what would take other consultants 2 days to do. So even though it's expensive per hour, I'm still a great value because I'm very efficient. But I'm very clear in my invoices that they got a business plan, or they got a strategy statement, or they got a research statement that has X or Y value to their business, so they can see the return on investment. They're paying me $500, but they're getting $5,000 back in return on investment, and they can't wait to pay the bill. So make sure your invoice is also basically a marketing document, so that you continue to reinforce the value of what you do. So that's also best practices. The other thing that that you have to do on the invoice is you have to put payment terms on there. You need to remind the client that that invoice needs to be paid in 15 days or 30 days or whatever it is you agreed to at the very outset. That also is best practices, and that also gives you the license that if the client hasn't paid you in that 15 days or 30 days, that you can pick up the phone and call the client and say, per our agreement, you know, and you saw it both in the contract when we signed the contract, and you also saw it in the invoices, that we are due payment in 15 days, and thank you very much in advance for honoring your commitment. So that also is best practices, and I will tell you 9 out of 10 small business owners that I've spoken to do not do any of those 3 things. They don't add value in their invoice, they don't have their invoicing policies, and they don't invoice on a timely basis.
All right, Dawn, thank you. And thank you again for being our author this month. This is fabulous information, great comments that we're getting here. I'm so proud to have you as one of our, as part of our FastTrac family, a facilitator there in New York City. And as Dawn mentioned, if you have additional questions, feel free to email those. You can email those to info@fasttrac.org, and I'm happy to forward your questions along to Dawn. So I want to talk and go into October. So October 15th is our next author series. Diana Kander will be presenting her new book, All in Startup, Launching a New Idea When Everything is on the Line. Again, thank you so much for attending. This recorded webinar, a copy of Dawn's PowerPoint slides, and how to order the book if you're interested, will be available on our website by the end of the week. Have a wonderful day.